Hello, everybody. My name is Josh Lipson. I see people entering the meeting now. We're going to give them about a minute to get in and join us, and we're going to go ahead and get started. Okay, my name is Josh Lipson. I am Vice President of Sales at Alpine Brokerage. With me today, our guest presenter is Tim Lockwood, Sales Vice President of Lincoln MoneyGuard team. Today, we've got a great topic for you. Studies tell us that 90% of those over the age of 65 want their financial professional to take the lead in the long-term care conversation, but most are not. Today, we are going to talk about what the default plan for most advisors and their clients are, and then we're going to talk about alternatives to that which create leverage and tax advantages. So in the interest of time, we're going to jump right in. Tim, thanks for joining us, and take it away.
Absolutely. First off, a big thank you to Alpine Brokerage Group, Josh Lipson, and a great team here. You got a tremendous amount of resources and support with the team over at Alpine. I appreciate everybody's time today. Really excited about this topic because the need for long-term care planning has not gone away. It's only increased. More and more of your clients are being impacted by a long-term care need, whether that's directly or indirectly. And today, we really want to highlight the tax advantage that your clients are missing and really look at, as Josh outlined, really the alternative or the default option and what those alternatives are. And the reality is most people are impacted by a long-term event, right? A long-term care event. And whether that's, mom or dad, aunt or uncle, they typically have a feeling or an understanding of what the impacts are, whether that's financially, emotionally to the family, or the fact that insurance does not cover care, especially Medicare, right? We really got to spend down all of our assets and have limited income to really rely on Medicaid. So as far as our time today, we'll cover, really what that default plan is, evaluate the current strategies. What are the defaults? What is your current strategy right now, whether you put pen to paper or it just became the default plan, but likely what your client's default plans are. We're going to look at those. Number two, we're going to look at the true cost of those plans. So we're not only going to look at what the cost of care is, but we're going to look at the cost of funding those plans. And then lastly, we'll wrap up and close with really a strong argument on why there's a more efficient allocation and location for assets that will be earmarked for care, whether that's the default plan or a more formalized, thought out plan with tax efficiency and leverage. So let's dive right in. Number one, location matters. If we could have all of our assets in tax deferred buckets that are distributed completely tax free, I think everybody would agree that would be a winning strategy for as much of the portfolio as we could allocate in that regard, especially if we can participate in the market. But when we look at the default options, right? It's cash, it's a brokerage account. Obviously, we're going to talk a little bit about our MoneyGuard story, but this is about tax efficiency and leverage. Timing risk comes into play. What's the most efficient way to transfer assets? Just a tremendous amount of wealth that will be transferred over the next 10 to 20 years, not to mention $6 trillion roughly sitting in money markets right now. So we're also going to factor in legacy planning and having access to those assets. So let's take a look at cash first, right? Cash is great for an emergency fund, something for a short-term emergency, maybe enough to get you through a transition period, but over the long term, and when I say long term, we're talking about 20 to 25, 30 years for a long-term care event. Lincoln's average claim time is age 83, Meanwhile, our average applicant and issued case is about a client in their upper 50s at 58. So we're really talking about 25 years here. And the odds of keeping up with cash just don't play out. Number one, on the left side, cash often outperforms. The longer your time horizon, the more frequently that cash is going to underperform the overall market. For example, the S&P. And in fact, even over a 5 to 7 year period, it underperforms 80 to 90% of the time. So for a long-term location of assets, for a long-term care need, cash is really just not the place to be. And by how much, right? How severe is the gap in the growth? It's pretty significant. So most of you would be looking to grab this cash and allocate it into the market, right? Again, cash is great for an emergency fund, but above and beyond that, for something you might not need for 20, 25, 30 years, not really a great location to grow those assets in the event care is needed. Now, here's where we would likely default and pivot that cash to. And again, over 6,000 or roughly $6 trillion in cash and money markets as we wrapped up 2023. So a great opportunity to identify that cash sitting in money markets and reposition, reallocate that to a planning opportunity. But when we look at the markets overall, this is likely what the majority of our registered rep partners in the field are doing with their clients. The market makes sense. We wake up every day believing that the market is going to return over the long run if we have that time in the market. And right here, we're just looking at simply three allocations: the S&P 500, an aggregate bond fund, and then an 80-20 blend between the two. And what we did here is we're looking at a rolling 10-year period, and we're looking at those periods over 133 cycles. And what you're seeing here is what you probably expect to see. Average returns on the S&P index over those 133 10-year rolling cycles is over 132%. When you look at an aggregate bond fund, it's over 44%. And even that S&P 80-20 asset allocation is at 114%. Not only do you see significant gains over these periods of time, which you can see in the middle there are no cycles or periods of losses, meaning that if we have time in the market, we usually win over the long term. That's why when we think of long-term planning needs, like building a nest egg in a 401k or an IRA or even a Roth IRA, we want to be participating in the market. Cash is not the winning position over the long run. And obviously, the longer we have, as I've alluded to, the shorter and tighter that standard deviation on those returns is. So when we look at these rolling returns from 1976 to 2023, you can see that you got a strong argument here for participating in the market. Now, if you're somebody who's heavily focused in wealth management and building and accumulating assets for your clients in preparation for retirement, you know all these numbers. This all makes a lot of sense for you. This is likely your default plan if you have not factored in more formalized planning by taking advantage of insurance. So we looked at our default strategies, the cash position, the market participation, and the brokerage account. Now let's transition to understand the true costs. Number one, costs can vary significantly depending on where you are geographically or what level of care you expect to have as you age and potentially need care. So these numbers, we're trying to land somewhere right in the middle, right? An average cost of care can be anywhere on the low end of $75,000 a year to upwards to $180,000+ a year. There are places that are well over $20,000 a month in the event care is needed in today's dollars. So today, we're just going to try to come in the middle here, a little bit conservatively on the cost of care. And when we look at 10 hours a day, a home health aide is about $30 an hour. And here, we're just looking at 10 hours a day with that home health aide and one registered nurse visit per day. Now, care can be at the home, care can be in an assisted living facility, and care could also be, in the worst case scenario, in a skilled nursing facility. And quite frankly, the most costly care could essentially be at home when you think about 24 hours a day. So we arrive at a number of just over $90,000 a year annually in today's dollars, but that could easily be significantly higher. And the reality is, we're not really looking to go on claim or need care anytime soon. We're healthy right now. So the key is what are those costs in the future? And inflation is top of mind for a lot of folks. So inflation is much more significant in the healthcare arena. So when we look at this down the line and in the future, 23 years from now, that 90,000 more than doubles. We're looking at roughly 200,000, could easily be upwards to $300,000 a year. So the question I get you to think about right now is, where are your clients going to pull close to $200,000 a year from a cash flow perspective? Does that come and get liquidated dollar for dollar from your AUM? Dealing with those tax consequences, these are the things that we really need to engage, especially from a numbers perspective and a financial planning perspective. Now, again, the numbers are vary significantly across the board. Not a huge fan of stats, because once you're 65, over 20% of claims last more than 5 years. But on the flip side, there's a good segment of claims that won't get through 18 to 36 months. So if we look at a 4-year need here and just use these numbers that we outlined, you're looking at about at least $800,000 to set aside in the event you need care. Now, that's the dollars and cents. If we think about the other cost to the practice and the wealth overall, the impacts to AUM could be significant, because upwards to 85% of adult children are not retaining their parents' financial professional after inheriting assets. It's a similar story for spouses who are widowed or widowers. So this is a great way to engage and get to that next generation. And we have transferable benefits that we can link these to the next generation, teeing you up to not only plan for mom and dad, but plan for those adult children that you expect to be your clients down the line as you transition those assets. So we kind of came to a number of about $800,000, arriving at that number with that 200 grand a year for 4 years. Again, that could be significantly higher, maybe a little bit less, could be a longer duration of claim. No one has a crystal ball on what their need is going to be, but the need could be devastating. So let's take a look at the funding of each of these strategies, backing into those numbers, if not giving us a little bit of a cushion on the higher end exposure. And clearly, cash is going to be your weakest link here. If we wanted to fund this over 10 years, so we wanted to fund a bucket to arrive roughly at that $1 million+ mark to cover that $800 to $1.2 million of potential need, we'd have to set aside 112 grand annually to arrive at $1.1 million, almost a dollar for dollar funding amount. Now, if we looked at a fixed income or a bond strategy, you're looking at about 80 grand a year. So you free up some dollars there because you're getting a higher return on the bond portfolio. So roughly 791 grand will have you arriving at about $1.4 million in 23 years. And then clearly, as we work up the rows here, the 80-20 asset allocation, which arguably is the default for many people outside of that cash position, it's the most efficient strategy based on what we've reviewed up to this point. If we had an 80-20 asset allocation in a taxable brokerage account, we would have to set aside roughly $29,000 a year over 10 years, or 290 grand over that period, to then arrive at a $1.4 million bucket in the event care is needed. So clearly, when you look at this, market participation wins over the long term, and that 80-20 portfolio is clearly the most efficient way to do this. But wait, what if we can cut that in half and take the amount of, say, $15,000 a year and trim that best case scenario in half with adding some tax efficiency, creating and adding some downside protection with some leverage. Let's take a look at that. So we talked a little bit about the default plan and where those assets are located. We talked about the cost of care and what funding those strategies would look like from a cost perspective. Now let's look at a more effective and more efficient strategy using a tax efficient strategy with MoneyGuard Market Advantage. So here we're going to look at a 55-year-old married male. And again, we are going to take about $15,000 annually and fund a plan over 10 years. And right here, we're going to stack this right up against that 80-20 asset allocation with that brokerage account and take a look at the past 23 years from a historical returns perspective. In our brokerage account, we can leverage the State Street S&P Index Mutual Fund and the Putnam Income Fund on the bond side. For our MoneyGuard Market Advantage, we have close to 50 variable sub-accounts that we can use. And in fact, we can use the State Street S&P Index Fund as part of the 80% to mirror that 80% allocation. We do have the Macquarie Bond Fund that we can use for that 20%. Now, a couple key items. With MoneyGuard, we're going to auto rebalance on a quarterly basis. So we take that right off of your plate. Number two, this is going to grow completely tax deferred because of the life insurance chassis and the tax benefits of cash value life insurance. We don't have to pay taxes on these gains year in and year out. Meanwhile, we're also delivering on some guaranteed premiums. So let's take a look at how this all shakes out. Number one, that $150,000 over that 10-year period of time in 23 years based on historical values, that's going to grow to about $507,000 with your investment strategy. Now, if you were making the argument solely on accumulation, I'd say, Josh, you got this. You win. That strategy wins, right? Yeah, you have to manage the tax exposure annually. You have to rebalance manually. And you're not deferring taxes overall, but you've got an AUM fee. There are some fees inside our MoneyGuard solution when it comes to the guarantees, some of the multipliers, and the downside protection. So you win if we're solely looking at accumulation. But that's not what we're talking about here. We're talking about a protection strategy leveraging market participation and tax efficiency. The first item we're going to address here is, well, what if I never need care? Because when you're dealing with an individual and a couple, that question might come up. What if I never need care? If I self-fund with you, I'm growing those assets in that available asset. Well, here we are winning. We clear by over $100,000. Close to $130,000 more is getting paid out in the event that we never need care. So by planning with MoneyGuard and an insurance strategy, you win if you never need care. Not only do you have $637,000 in a tax-free death benefit, the beneficiary, if they have their own policy, can take some or all of that and transfer it and roll it in to an existing policy without any additional underwriting. Extremely powerful story for a surviving spouse, for adult children, for business partners. Really, the doors are wide open. Meanwhile, I could argue that you could recover all of your premium and some by taking cash and income and say $200,000 to $300,000 and still roll over another $300,000 to an existing contract. If you have multiple beneficiaries, say 3 adult children, each get $100,000, they can roll some or all of it into their policies. A great way to connect to that next generation. Now, what are we really doing this for? We're doing this to protect retirement income, assets, wealth, and the family for long-term care. And in the event care is needed, what we're going to deliver on is a 400% multiplier on that available asset and that cash accumulation. So that $430,000 that we would have arrived at in 23 years, we're giving you a 4-to-1 leverage point on that dollar completely tax-free for a long-term care need. A very powerful story. Meanwhile, we lock in guarantees annually with some downside protection. which is a 2.5 to 1 multiplier in the event there is a downturn. So in this scenario, if there was a downturn, we would have locked in close to $1.1 million of a guaranteed LTC pool while still having an uncapped upside of that 1.7 million. So as we look at these numbers, what's the better strategy? The investment strategy, where when you arrive in 23 years, your 507 is not only your available balance, but is also your legacy benefit and your LTC value, essentially spending down those assets dollar for dollar from the portfolio, or having a 4 to 1 multiplier on accumulated growth, where now you're protecting well over $1.2 million above and beyond that 500 grand that you grew that asset to. So as we look at this strategy, we really win out. It's hard to argue. I welcome an argument on how this stacks up against a self-funded default strategy, which, quite frankly, over 80% of Americans are going with the default plan of self-funding or spending down assets only to rely on Medicaid, which doesn't really give them a lot of control over their care. So location matters. We are checking a lot of boxes with Lincoln. We've been doing this over 36 years as of this summer. This is a tax-efficient strategy with leverage, downside protection, efficiency from a legacy planning standpoint. And you know what? You still have access to that asset, whether that's a tax-free loan on a non-MEC design contract or a complete exit strategy on that value. The nice thing that we did is we just rolled out some updates to this where you could take cash indemnity or you could take reimbursement. And we've added some variable sub-accounts with our fund partners First Trust. So we're constantly looking to improve upon these solutions, whether it's flexibility in how we want to fund, flexibility in how we want to grow, and then flexibility on how we pay out benefits, whether that's cash indemnity, reimbursement, transferring that death benefit, or taking that death benefit as cash and income. So where are the clients? Where is the market? If I go back 16, 17 years from when I started, the majority of our business came from cash-strong clients between 55 and 75 years old that stroked one single check. It was an asset reposition from money managers repurposing some of the asset allocation or uncovering some cash coming due, likely down the street at the bank. What I'd encourage you to do is we can issue this solution all the way down to age 30. And we are seeing plenty of cases starting to come in from clients between ages 30 and 50. You certainly should be talking to all your clients between 45 and 65 about this across the board. But think about those high income earners, those who are receiving bonuses that don't want to, increase their tax exposure. They want to decrease their tax exposure over time. Think about those folks that might be capped out on the Roth or capped out on those income limits. Think about those pre-retirees and those income earners that might be taking care of mom or dad. My question to you is, do you know if they're taking care of mom or dad? Ask the questions. Have you or a loved one been impacted by a care need, a need for extended care or long-term care? And obviously, retirees and these cash-strong clients on the right-hand side here are some low-hanging opportunities. But the older we are, the trickier the underwriting gets. We do approve 80% of our business. Once we're 60 or under, we actually waive a cognitive exam and we're pass-fail on a PHI process. So the younger we are, the more efficient the plan and the process is, and the more powerful the overall planning is. So I highly encourage you to broaden who you might be engaging with around the long-term care planning need. Certainly broaden who you're engaging with down to those clients in their mid-40s. Why not take some of that excess disposable income and repurpose it on a monthly or yearly basis over a flexible period? We'll guarantee those premiums and take advantage of that uncapped upside across the board. So with that, Josh, we covered a lot. We tried to get through it efficiently. Essentially, we talked about the fact that what is the default plan and what are those default plans as far as cash and a brokerage account, why those asset locations might not be the ideal scenario. We talked about not only the cost of care, but the cost of funding those different strategies and how inefficient some of those asset locations can be. And then we wrapped up with a powerful story around our MoneyGuard Market Advantage, some of the enhancements with our indemnity payout feature, and really how MoneyGuard Market Advantage stacks up with that default plan of that 80-20 asset allocation. So I encourage and ask everybody on this call, think about your best clients. Think about the clients that you have on the schedule over the next 2 to 3 weeks. Reach out to your team at Alpine, and we'll help you kind of come in with the landing point on an illustration design, get you prepared for that meeting, get you lined up with the right questions to ask and the proper positioning strategies to really make this successful. My question would be is, how many client conversations on a weekly basis would you have to find 1 to 2 couples a quarter? 1 to 2 couples a quarter can really add up to not only significant revenue in today's dollars for your year, but arguably would protect and insulate your AUM over the long run. So Josh, I don't know if we have any questions in the queue right now, but again, I thank the entire Alpine team. Josh is a great partner. Alex as well. Nick, if you work with him, reach out to your Alpine Brokerage Group team members, and let's create a design and customize a plan for one of your upcoming meetings. Thank you for your time today.
Thank you, Tim. Fantastic job. Not much to add there, but I will say it's hard to imagine that it would be in the client's best interest not to utilize the leverage and the tax advantages that we gain from these innovative insurance products. So with that, thank you very much for your time. Please reach out to myself and my team, Alex, if there's anything we can do, if you have any questions, and we look forward to working with you. Thanks so much.